To the markets, where China's decision to let the yuan rise very slightly today supported the Aussie dollar but failed to stop the ASX going south. Banks, miners and energy stocks in particular were all sold down, and it finished the week down 2%. Across Asia, Japan's Nikkei struggled, as did Hong Kong, and Shanghai is modestly higher. And the Australian dollar is up a little against the major currencies. Michael McCarthy from CMC Markets joins me now. Michael, iron ore first. What did you make of that Atlas result?
Well, it really illustrates that it is now a fight for survival for Atlas. And while the company and its partners are doing all they can to keep this company a going concern, there's one thing they can't control, and that's the relentless increase in supply that's coming out of Vale in Brazil and the Pilbara producers here in Australia. And if that supply increases and consequently puts pressure on the iron ore price, it could be the end of the game for Atlas.
The miners have been pretty beaten up this week. Any chance of bargain hunting pushing up prices next week?
Well, it's been the best of weeks and the worst of weeks for material stocks. They've topped the tree yesterday in trading. However, previous to that, they've been under extreme pressure. We have seen some evidence of bargain hunting, but volumes fell away sharply today, and it looks like we'll need a spur to get investors to get involved in the sector again.
We've seen the continuing decline in oil prices now starting to really weigh on the energy sector. We saw Santos today off nearly 9% by the close. Any reprieve in sight there?
It appears not. Overnight, we saw oil trade down to 6.5-year lows. During the Asia-Pacific region today, that oil price traded even lower, and that's what's really putting the pressure on the energy sector, the worst performing sector today. Santos is suffering a double whammy because not only is it suffering from that lower oil price, it's also being hit hard by its inability to develop its CSG tenements in New South Wales, and that double hit has seen it trade down from above $15 last year to below $6 today.
And James Hardie still looking at profit reports now. James Hardie riding the housing boom with today's profit update.
Yes, and quite upbeat about the outlook for housing in Australia. However, trying to calm down investors. Analysts have got a little enthusiastic. Their projections for profits got a little above what the company thought was reasonable. And in toning down those expectations today, what did take a little bit of a hit, although found some support and traded back to flat on a weekday. A pretty good performance after today's result.
I mentioned it earlier, the Chinese authorities just raised very slightly the valuation of the yuan today. We're still in correction territory though, aren't we, because of the massive falls that we saw earlier in the week?
Absolutely. Local investors seem to accept the idea that the moves of the yuan this week were about moving it away from a fixed currency to a floating currency and not about a weak Chinese economy. But that didn't spur any buying in the market today. Now, volumes dropped right off. We're well below average for a Friday or for any day. But it did seem some exhaustion was in the market, and with it now down by more than 10% from those highs we saw earlier in the year, officially in correction territory.
And so where does all this leave us with US interest rates and whether the Fed will go? Because the changes in the yuan has done a little bit of the work for the Fed Reserve, hasn't it?
Yes, it has. Now, economists are almost unanimous that the US Federal Reserve will lift rates come September. However, the market's not so sure, and we've seen a lot of fluctuation in sentiment around the idea that we'll get a rate rise that early. Last night we saw some stronger figures, particularly jobs numbers, and that had the market flip back again to more likely than not that we'll see a US interest rate rise in September.
Michael McCarthy from CMC, thanks very much for your time.
Thank you.